Good.
Right. What I did was I sent you some questions yesterday.
Yeah.
What you can do is, it's a good thing actually for you to do the question without looking at the answer.
Oh, yeah. That's what I'll do. I won't
Yeah.
look at the answers.
Yeah. Then look at the answers because some of the answers are good, some of the answers are not good. But look at the answers and then you might find certain areas where you find struggling. Just send me a mail. Then I can give you whatever that I need to tell you.
Okay.
That's a great way to go ahead.
Yeah.
Right. So, out of our first week's one, we have covered up the first 6 hours. We have covered the business framework, audit, ethics, corporate governance. There's a little section which we need to do today, IS 12, for the income tax. And then we move into the big areas, subsidiaries, associates. This next 6 hours will be one of the key areas for our studies.
Okay.
Right? So we are going to move into the first area. It's all about the income tax. So remember the other day, the first couple of lessons we did how to the income tax laws, then we saw how to calculate the income tax, all that kind of a thing, right? Today we are going to look at the accounting for income tax. This is under IAS 12. So when you calculate, say for example, in UK, the tax year is from April to March. So when the accounts are closed, you will prepare your tax calculation the way that we did. Look at the taxable income, add disallowed expenses, deduct all the allowed expenses, all that. You will arrive at your taxable profit. And if the tax rate is 25%, you will say that for the year ended, say 2015-16, you might say the tax payable is estimated. So when you prepare 31st March 2016 account, you might think that the tax, according to your calculation, tax payable is 40,000. So what you do is you debit your income tax expenditure account, which is expenditure account, 40,000, and you know you have to pay that one and it's going to be paid in next year. So you credit current liability with 40,000. So that is what you will do when you prepare accounts for the year ended 31st March 2016. You have worked out it to be 40 and you will debit income tax and credit liability with 40,000. That is what you feel. But however, during the year, maybe 2016-17 year, the tax authorities might rework, the HMRC will rework and tell you, hey, Johnny, it's not 40,000, it should be 42,000. So last year, for example, you made a profit of 120,000. Profit before tax 2015-16. You provided 40,000 as tax liability, tax expenditure. And you thought you will have a profit after tax of 80,000 and maybe out of that one you would have paid a dividend also. So that's what would have happened last year, 2015-16. But in 2016-17, the taxman says, no, 40,000 is not right. Your real tax liability is 42,000. So long time back, what we go and do is we go and adjust the previous year. But now we can't do that one. So what we look at is we look at the 2016-17 financial statement. 2016-17 also, based on your normal profit, based on your calculations, you might think your tax liability for 2016-17 is 50.
I can't really hear you that well. Hello?
Pardon? Hello? Hello?
I can't really hear you that well.
Can you hear me now?
Yeah.
Yeah. Yeah, sometimes when I'm writing on the board, you might not hear me. Just tell me, because sometimes when I touch on the board, it disturbs. But otherwise, let me know.
Okay.
Right. So 2016-17, I'm thinking that I have worked out the next year my tax liability to be 50,000. That is my estimated tax liability. So in 2016-17, what again I will do is I will debit income tax 16-17. With 50,000 and credit my current liability with 50. Last year, even though I credited my current liability with 40, the tax authorities say that's not right, not 40, it is 42,000. So I had to pay 2,000 extra. So cash I had to pay 42,000 even though I said my liability is 40. Why did that arise? Because I have underprovided 2,000 tax for last year. That is for 15-16, I have underprovided tax of 2,000 last year. Now I can't do anything with last year's thing. So what I do is that 2,000 under provision, I will charge it not for the last year, but for this year 2016-17. So 2016-17, income tax account will have a 50,000 debit. That is my estimated liability for 16-17. But also I will debit another 2,000 because my current liabilities is now have a credit balance of a debit balance of 2,000. So I will credit my current liabilities with 2,000 and debit my 2016-17 income tax with 2,000 extra. So my P&L chart for 2016-17 will be not 50, it is plus 50 plus 2, 52,000. That is what is going to happen. This is what I call a last year's under provision. So what I want you to note down, always you estimate your liability and you provide it as a current liability. But next year when the tax authorities finalize, they might find that you have underprovided. In that case, next year's your tax expenditure, in addition to your next year's estimate, another 2,000 need to be added up, what we call under provision. So that is 2016-17, right? Now let's assume at the 2016-17, how much you provided? 50,000. Because of the 2,000 last year, your expenditure is 52, but you really provided only 50,000 for the 2016-17. Now the 2016-17, the tax man might come and say, hey Jenny, you don't need to provide 50,000. Yeah, according to our calculation, the tax payment is only 47,000. So next year, when you provided the current liability, 2016-17, you provided 50,000. The taxman says you don't need to pay 50,000, you have to pay only 47,000. So you will be very happy.
Yeah.
The taxman says less tax has to be paid, you will be very happy. 47,000. So that means in 2016-17, you have over-provided 3,000. Right? First year you have under-provided, second year you have over-provided 3,000 because your liability is much more than or much less than what you provided. Actual liability is only 47, what you have provided is 50,000. So 3,000 over-provided. So now if you look at 2017-18, let's assume that your tax expenditure you have estimated 2017-18 to be, let's assume it is you have estimated it to be 52,000 or 53,000. Say 52,000. So again, you will do the same entry. Debit income tax, credit current liability in 2017-18 with 52,000. But we don't need to charge the entire 52,000 to the P&L because we have a credit of 3,000 here. We can transfer that to the P&L of 2017-18. So 2015-16 we charge the P&L 40. 2016-17 we charge the P&L of 50 estimated plus 2,000 of last year under provision. 2,000. In the 2017-18 we thought our provision should be 52, but we have a last year over provision of 3,000, so we need to provide only 49,000, or we need to charge the P&L only 49,000. So you can see there can be always between what we estimate and what the tax people estimate, there can be differences. If the tax people estimate much more than what we estimated, that is called the under provision. If the tax people estimate less than what we have provided, then we call it over provision. Any under provision of the previous year will be added to the next year's tax liability, tax expenditure. Any over provision in the previous year will be deducted from the tax expenditure of the next year. So this is all what we need to know about the IS-12 income tax. There's a third category called deferred tax, but that's not in your F1 syllabus. It will come up in F2 syllabus. Therefore, we will not worry about it at the moment.
Okay.
So IS-12 covers up three areas. Current tax expenditure. As I said, the current tax expenditure is what you do. You debit P&L 40,000 or whatever the figure, credit current liability. Then any over or under provision for the previous period, that is you have provided anything less or more, that amount what you have to do is your debit income. If it is over under provision, debit income tax expenditure, and you will pay by cash. If it is over provision, credit income tax expenditure of the following year. You can't adjust anything for the previous year.
I can't really hear you. It's breaking up. Can you say that again?
Yeah.
About the over and under?
Yeah, that's right. Because I was writing at that time, you will not hear. Now I will tell you again. When it is
Okay.
it is under provision, that means last year you have under provided. That difference you will charge it to the next year's income tax expenditure account. You will add it. If the next year's expenditure is 40,000 is estimated, you will add it under 2,000 under provision, and you will make the next year income tax expenditure 42,000.
Okay.
If it is over provision, last year you have over provided that the taxman says you don't need to pay so much, then you will deduct it from the next year's, you will credit income tax expenditure. So next year if it is 50,000 expenditure, if there was an over provision of 3,000 in the previous year, you will charge to the P&L 50 minus 3, 47. So simply what you have to learn is this: any under provision of the previous year, add it to the current year income tax expenditure. Any over provision of the previous year, deduct it from the next year's income tax expenditure. That's all.
Okay.
So if you remember that one, that should be all right. You don't need to worry about the third component, deferred tax, because it's coming under F2.
Okay.
So just remember these things. So we will be looking at some numbers later on. So current tax, as I said, is the estimated amount payable. At the end of each year, the entity will calculate the tax, estimate the amount, and this is recorded income tax expenditure debit, statement of profit or loss, income tax payable, credit, statement of financial position, current liability. So that's a normal entry you will make as you prepare your financial statement.
Okay.
When the next year comes, there may be over or underestimate. Any under over provision, you don't go and adjust it for the previous year. You adjust it for the next year. What you do is, if it is under provision, it will appear as a debit balance. So in the trial balance, once they give it, if it's an under provision, that means you have overpaid. That means it will appear as a debit balance in the trial balance. So this is very important that you know this one. Any under provision, because the examiner might give you a trial balance. If it's a debit balance in the tax account in the trial balance, that means it's an under provision. If it's over provision, that means you have underpaid or you didn't have to pay everything. It will appear as a credit balance. As I said, always your next year's income tax expenditure will be the current estimate plus under provision or current estimate minus over provision.
All right.
This or that should be your current income tax, 40,000 plus 2,000, 40,000 minus 3,000. Statement of financial position, always you will have the current estimate as a current liability. This slide is the most important one. It explains everything what you need to know about the accounting under IAS 12.
Kumar,
Yeah.
just 2 seconds. I'm having some issues printing the slides. They won't print correctly. They won't print onto A4.
You should be able to, you have to adjust it. You have to put the PowerPoint slide in the printer, this thing, make it fit to page and print it.
Okay.
I'll
try tomorrow.
What is your printer? What's your printer?
It's one at work. I can't remember, but it's one at work. Every time I tried to do it, it wouldn't print.
All right. Okay. Go to the printer and because I have been printing, I can print it. What you have to do is go and adjust it fit to the fit to page, and then go for the print preview. See whether it is been previewed, and in that case, you should be able to print it.
Okay.
So that's all. Actually, we need to learn about IAS 12. So we will be looking at some questions later on, and we will learn more about that. So I will, just like what I did with the other ones, I will send you some questions for you to tackle about IAS 12.
Okay.
Right. So now we move into the big area. We are starting off with what we call, I think it is all about the accounting for investments in subsidiaries and associates. It's about accounting for investment in subsidiaries and associates. Now, you and I, we as individuals, we go and invest money in a company and buying shares. But we may not buy lot of shares. We may buy, the company share capital may be 1 million. We may buy 10,000 shares. We may buy 20,000 shares. Not a very big interest we have. And that's basically what we will be having. But sometimes it's not only the individuals who buy shares, the companies themselves buy shares in other companies, right? So when the companies buy shares in other companies, we have to look at the investment in a different form. So for example, the company A, or company called P, let's assume a company A has a share capital of we are looking only when we talk about the share capital for associates and subsidiaries, all that, we look at what we call voting capital. That is, there are two types of share capital mostly for companies. One what we call ordinary shares, the other one what we call preference shares. Do you know the difference between preference shares and ordinary shares, Jerry?
Is it to do with the rights, the voting rights or something?
Yeah, right.
Or
Yes,
the
right.
set
Yeah.
dividends?
Preference
Yeah.
shareholders, they are entitled for a fixed dividend. They don't have any voting rights. Ordinary shareholders, they are not entitled for any fixed dividend. The directors can decide any dividend, whatever they want to pay, but they are the real owners of the company, so they have what we call the voting right. They can vote to remove directors, they can vote to appoint directors, they can vote to reject the financial statements prepared by the board of directors, they can vote to remove the external auditors. In other words, they exercise power through voting. So let's assume that a company A has 100,000 what we call voting shares, and sometimes this is called, not sometimes, most of the time it is called equity shares. Equity shares. So if you hold, say, if you are an individual, if you hold 1,000 shares of this company, in other words, you have 1,000 voting rights. Out of 100,000 voting rights, you have 1,000 voting rights. So you have 1% voting rights. So you are not a big person, but still for all, you can come and vote. 1% of the vote belongs to you. If I hold 2,000 shares, I will have 2% voting rights in this company. That's the normal. Sometimes a big individual, a big rich man can hold more than 50,000 shares in this company. If they hold 51,000 shares in this company A, he will be what we call a controlling owner. Controlling. He can control the company because even if all the other 49 fellows get together, he has a 51% interest. So he is the major dominant part. Similarly, just like any individual, one company called P can invest in company A. He can invest out of 100,000. He can buy just, shall we say, 5,000 shares. The company P. It's another separate company. They buy 5,000 shares. So that means they have a 5% holding. Of 100,000, a 5% holding. So this will not give them any controlling power, nothing. He will only get a dividend. The company P will get a dividend when a company A declares a dividend, and this is just called ordinary investment. Ordinary investment. But if out of the 100,000, if the company takes anything more than 20%, so let's assume they take 25,000 shares, that means 25%. So anything between 20 and 49, if company P holds shares in company A, then it is called that they have a significant influence over company A. Significant influence, that is the key word. Significant influence means you can't control because you don't have a 50% holding, but still for all, you are a big person, your voice will be heard. When you say something, they will listen to you. 5,000, they might not listen to you. But 20,000 holding, 21,000 holding, 48,000 holding, a percentage wise, I'm taking for easy calculations, I'm taking 100,000, it can be 200,000. But what is interested is the percentage of that 200,000. In this case, the percentage of 100,000, whatever that you hold, that amount of holding gives them what we call a power, not to control, but to have a significant influence. What do you mean by significant influence? The people can talk and their voice will be heard, and the company P can appoint not the majority directors of company A, but 1, 2 or 3 people. So not too many people, but they can appoint some people in the company A as directors because they have a significant influence. So in this case, the company A is called an associate company. Company A is called the associate company of company P. P is the main company. In that A company, you are holding 20% to 49%, 21, 22, 23%, whatever. Then you are called, the company is called an associate company. Now, sometimes the company P may not hold 25%, company P might hold 60%, 60,000 shares, 60%. In that case, the company that is anything over 51% to 100%, if that is the case, then what we call is you have the control. The company P can control the company A because they hold more than 50%, 51% or anything more than that, and that is what we call control. And in that case, that kind of a company, as far as P is concerned, it's called a subsidiary company. So we will be looking for accounting. If it's an associate company, there is a separate accounting treatment. If it is a subsidiary company, there's a separate accounting treatment. So through these slides, we will try to learn the accounting for investment in subsidiaries and accounting for investment in associates. So first of all, we are
I think I missed it. Just 2 seconds. I think I missed it. So when they have control, they're a subsidiary when they have control?
Yeah, when they have anything more than 51 going up to 100%, then you have control, and that means the company is called a subsidiary company of company P. Company P is called the parent company. Company A is called the subsidiary company. But if you are holding anything between 20 and 49, then you hold a significant influence. In that case, company A is called an associate company of company P.
Yep, I got it. Yeah, we can move on.
Right. So there are two accounting treatments. So we are going to look at the first of all, the accounting treatment. So as I said, there are 3 stages. One below 20,000, 20%. Then it is called just an ordinary investment. We will learn about it in later. 21 to 49, it is called investment in associate. 51 to 100, it is called investment in a subsidiary. We're going to look at the first one, actually not the first one, the second one, investment in associate. So associate is an investment where the investor has significant influence. So generally, if you have anything between 20 and 40%, 49%, it should be a significant influence. Sometimes, so it should not be a subsidiary. Subsidiary means it must be holding more than 51%. Later on, we will learn something called a joint venture. Joint venture means you have joined with another company or other companies 50-50, for example. You're holding 50% of company A, then that means you're a joint venture with another company that is holding 50%. In that case, it's a joint venture. But joint venture, don't worry at the moment. We will learn it later, little bit, because it's a F2 subject.
Okay.
Significant influence is defined as power to participate. Now, I want you to understand those words because in your theory paper, you will have lot of words to play about. It is not power to control, power to participate in the financial and operating policy decisions of the investor. Invest in the company A, but not control or joint control of those policies. So you are not controlling, but you have the power to participate. You are not a controller, you are not a joint controller, but you have the power to participate in the financial and in operating, and that is what we call a significant. So generally, if you hold anything more than 20% or more in the voting power, it's perceived to give significant influence unless it can be clearly demonstrated that this is not the case. So when the examiner says that a company holds 21%, company holds 22%, company holds 49%, generally the assumption is that it is an associate company.
Okay.
Less than 20% will not give significant influence unless such influence can be clearly demonstrated. So the pre-assumption is if it is below 20%, no significant influence. If it is more than 20%, you will have significant influence. So what are the significant influence factors? So sometimes the examiner might not give you the holding, but he might give you some of these factors so that you will know it's an associate company or a subsidiary company. It is represented on the board of directors. Not that you can have the majority of the board of directors in company A, but you will have a fair number of board of directors. So the company A board has total board is 10 people. Maybe you will have 3 people of your nominees because you have a significant influence. But surely you are not going to have 5 or 6. If it is 5 or 6, that means you are controlling the company. That means it's a subsidiary. Do you remember last time when we were discussing corporate governance, the board of directors control the company. The board of directors control the company by the virtue of the power given to them by the shareholder. So if you have more shareholders, that means you are controlling more board of directors. That means you are controlling the company. But if you have 2 or 3 or 4, it may be a significant influence. That is one indicator that you are having a significant influence. Then it participates in policy making process. So recruitment policy, employment policy, purchasing policy, even about dividend policy, they will participate, but they can't control, they can't dominate, but their views will be heard. They will be given an opportunity to participate. When the budget is prepared, the directors of the company, parent company, can talk about it. They may not be able to completely outvote you because that's not possible. There are material transactions between the investor and the investor. Now that's a very important one. Your company, the parent company, has invested in the associate companies, let's assume 25%. The main reason why they invest is, to have some influence over A, because sometimes A may be supplying raw materials to you, right? So there are a lot of intercompany transactions. A is the raw material supply. By having a 25% control, a 25% voting right over A, you can influence the company A to supply raw materials to you. Generally, you take a significant influence because there is some interest that you have, or either maybe he is your agent who is selling your goods, and therefore you want to have a control, not a dominating control, but some kind of influence, so you can tell at the board level, look here, that your company is not selling my products enough. Look here, your people are not supplying me enough goods. That kind of a thing can be coming out of the significant influence. So there will be material transactions. What do you mean material transaction? Company P may buy raw materials from company A. Company P may sell some goods, finished goods to company A. Company P may hire some people from company A. Company P may take IT services from company A. So in other words, there are intercompany transactions always happening between company P and company A. There's interchange of managerial person because these are companies are called closely connected companies. So sometimes they might take your IT manager and plant him there. They might take your CFO and plant him there. You might take their marketing manager and plant him here because they are more or less like home and home companies, a kind of like a family relationship. So you can interchange managerial people. Lower levels, it may not be very easy because unions might fight it out. But at a managerial level, you may be able to interchange people. So that's a good sign that it is an associate company. This is what do you mean by significant influence. If I just invest 10% in a company, I can't go and ask them to give the IT manager to me. But when I have 25%, I can talk to them and say, hey, can you give your IT manager for 3 weeks to my company, of 6 months to my company. Essential technical information, mostly IT information, mostly communication information, mostly marketing information, things like that will be provided by either of the two companies. Parent can provide to associate company can provide to parent. So remember, it does not mean that the flow will be only from this side to this side. It can be from this side to this side also. So these are the factors. If the examiner says if any of these factors are there, probably that means the relationship between the two companies is one is a parent, the other one is an associate company. So as I said, intercompany transactions are there between associate and associate. So how are we going to work through this one? So intercompany transaction between the group and associate are not eliminated within the consolidated comprehensive income and the consolidated statement of financial position. Not eliminated. So you can have a sale from the parent to the associate. When you are doing the two companies together, you don't eliminate the sale because even though it's an intercompany sale, it is you are not controlling the company and therefore it can be considered as an outside sale. However, because it is outside the group, it is not part of your group. For it to be a group company, it must have a controlling interest. Later on, when we come to the controlling interest, we will learn that is where we will be eliminating everything. But associate company is a kind of a family member, like a cousin, but not so close like your brother or sister, something like that. So because of that, we don't try to bring everyone into our family. We do transactions, and a transaction is perfectly a legal transaction between the two entities. You don't need to eliminate. Having said that one, any unrealized profit on the transactions must be eliminated when we merge the two accounts. So what we mean by consolidation is merging the two sets of accounts. The parent and the associate are merged to prepare one set of accounts, but you have to remember, parent prepares its own single entity statements, associate prepares its own single entity statements, but in addition to that, we will prepare something called between the parent and the associate. Whenever there is a consolidation happening, we will talk about consolidation in a minute. Consolidation happens whenever there is a subsidiary involved. We will talk about that in a minute. But if the consolidation is happening, any unrealized profit, that is parent has sold goods to A, let's assume parent has sold goods worth 10,000 to A. And let's assume the parent has made a profit of 3,000, a 30% profit on the sale. Parent has earned a 3,000 income by selling it to A. But A has not yet sold it to the outsiders. let's assume the entire 10,000 sold is not yet sold to the outsider. So now, if parent decides to take that 3,000 as a profit in the company P's books, that is not right. Reason? Because the entire 3,000 is not yet realized. So parent P company can't take for unrealized. This is called unrealized profit. The reason A has not yet sold the goods to the outside. What happens if A sells goods to the outside? Then of course there is no unrealized profit. P has sold to A and A has sold it to the outside. So then there is no unrealized profit. So unrealized profit remains only if there is any inventory left over. Inventory left over. So if P sells to A and in A's books if there is inventory worth 10,000 and if P has made a profit of 3,000, P should not take credit for that 3,000 profit. Reason? Because company A has not yet sold. Similarly, other way about.
And is it just under consolidated, or this is even on their own one that they have to do?
No. Only on the consolidation. As far as P is concerned, P's own accounts, it is pure profit for him.
Okay.
No problem. Don't worry about that one. But the moment you merge the two set, you can't take that intercompany profit. Right?
Okay.
That's what happens. Similarly, the opposite also can happen. A can sell to P. A can sell to P, right, goods. And A might sold a goods sold for 10,000 and P has not yet sold any part of that goods that is unrealized. So if A has made a profit of 3,000, when we are looking at associate company profits, that profit must not be considered because that is not yet realized profit. So again, as far as associate is concerned, it is a pure profit. But when you are merging, it is not yet a profit. That is how it works it out. Right?
Okay.
So always you have to look at, so we will look at some of these things detailed in a minute. Only the investor share of the profit is removed, since the CFS only will reflect the investor share of the associate. And that's a very important thing. Even though the P company has sold goods to A and earned a profit of 3,000, I said the 3,000 is intercompany unrealized. But even though it is intercompany unrealized, I don't need to worry about the entire 3,000 because my holding here is only, let's assume 25%. So my unrealized profit element is only 25% of 3,000, not the entire 3,000. Because 75% I don't own it. It's owned by some outsiders. So as far as they are concerned, that is a profit for them. And as far as I'm concerned, it is my 25%. So that 3,000, 25% of that 3,000 is what we call unrealized profit. It is only the share that we hold. Same with the A in P. If A sells it to P, same thing, because only 25% I need to eliminate. I don't need to eliminate the entire thing because this balance 75% not my responsibility. I don't need to worry about that one. So only the.
So we're talking about. We're talking about if P had a 25% share in A.
Yes.
They sell the goods for the profit is 3,000.
Yeah.
But because they only have a 25% stake, they only get 25% of the 3,000. That's what we're talking about.
They would have got only 25% of 3,000 and that they have not got it, and that we will remove it from the profit.
Okay. All right, I get you.
Yeah. That we will remove it as unrealized profit, provision for unrealized profit.
Right.
The other 75%, as far as I'm concerned, it is realized. It is my own intercompany share that is not realized. Now I told you about the 10,000 goods being sold, 3,000 is the total profit. What about if something happens, 10,000 goods are sold, but out of that, half of the goods are already sold. Half of the goods are sold. Out of the out of the 5%, say 50% of the goods are sold and only 50% is outstanding. So on the 10,000 you have a 3,000 profit. So on the 50% you will have a profit of 2,500, isn't it? Yeah.
Yeah.
1,500. 1,500, 25% is the unrealized profit. So we have to only look at the unrealized profit only for the amount of real unrealized, not on your total sale. You have to look at the what is in inventory. On that amount, our share is the unrealized profit. Is it clear?
Yeah.
So that's all we need to get to know on the unrealized profit. So later on we will look at, so the provision of unrealized profit is the percentage, the P percentage, that is the 25%. The parent is only 25% and unrealized profit in inventory is 3,000. Provision for unrealized profit is 750. If half of the goods are sold, only half is available. It will be 375. So you have to just calculate that one, and so long as you go through these steps, you are not going to miss anything. So that's why I'm giving you these steps very carefully. So now I'm going to look at if that happens whenever there is a merger happening. So remember, in the single company entity, you are not going to do any adjustments. They will prepare as it is. Now I'm looking at the scenario, parent selling to associate. Parent selling to associate. So let's assume 25% is our holding. They have sold goods worth 10,000 to 13,000. They have made a profit of 3,000. And let's assume for simplicity purposes, nothing is not yet sold. So on the 3,000, when the parent sells to the associate, what have we got to do? So let's look at this one very carefully. In the consolidated statement of financial position, we would have taken the entire 3,000 profit in the parent, because the parent would have sold so many other goods to all the other people. Let's assume the parent has made a total profit of 50,000, not only by selling to the associate, but selling to the others. Also, there is a 3,000, there is a big amount earned. But out of 3,000, we know 25% of this is what we call provision for unrealized profit. 750 I must remove from the parent profit. So the parent total profit of 50,000, I have to remove 750 because that 750 is not a real profit because that's an intercompany profit. And investment in associate. Now, originally to buy this investment in associate, maybe let's assume that we bought this 30% holding in the parent, in the associate company, and we paid, let's assume we paid 75,000. So this is what we call the cost of investment. Cost of investment. So let's assume at the very beginning of the year, we invested 75,000 in the investment. And during this period, company A, the associate company, let's assume that the company associate, from the day that we took this 25% control, company A has earned 20,000 income. I'm putting some figures. From the day that you took the insignificant influence, let's assume that we took the insignificant influence on 1st of January 2016, and on that day we paid 75,000 to buy the investment of 25%, and from 1st January 2016, let's assume that we are on 31/12/2016, the company A has earned 20,000 income. So when they earn 20,000 income, company P is entitled to 25% of that 20,000. So profit, what we call post-acquisition profits, from the day that we took over the company, it is 20,000. 25% is our share. So 5,000, we will add it up. And this is how I will show my cost of investment in associate in the merged statement of financial position. But whenever there is a unrealized profit 750, I must remove that one, because when I took over that profit of 25%, I have taken in that into account. So my investment should come down by 750 and should appear at 79,250. So when the parent sell to associate, these are the two entries we will pass. Reduce the consolidated retained earnings, because the parent company earnings will have to be reduced, and your investment in the associate company also will be reduced by 750. These are the entries we will pass. That is when the parent sells to the associate. In the consolidated statement of income, increase your cost of sales, that is to reduce that 750. We will increase the cost of sales by 750. That I will teach you when I'm doing the P&L of the associate company. So that is when the parent sell to the associate. Now look at associate selling to the parent. Here is the parent. Here is the associate. Associate is selling to the parent, and associate has made a profit of 3,000. And parent is holding in associate 25%. In that scenario, you will agree with me, the associate company profits are overstated by 3,000. Right? We don't need to worry about the 3,000. Reduce the consolidated retained earnings. Again, what we will do is, we will take that associate company profit. If the associate company has made a 20,000 profit, to our P&L, we will take 30% of this, 25% of this, our P&L for the year as income from associate company. So our P&L will have our profit, parent company profit of, let's say parent company has already made a profit of 30, and associate company made a post acquisition profit of 20,000. 25% belongs to me. So 35 I will show in my parent company books as my earnings, but I can't show that one because I know that 3,000 is not real profit. It's unrealized, but I don't need to worry about the 75%. I need to worry about the 25%. So 750 I need to remove. So again, you can see your consolidated retained earnings will be reduced from 30 is your parent company profit. This is your associate company share. But associate company share is overstated by 750 because it is unrealized. So I will show in my P&L 34,250. That is what I will show in the consolidated statement of financial position, retained earnings. And now because when the associate says to the parent, it is my inventory. So my inventory is overstated by 3,000 because it's an intercompany sale. So I may have an inventory of my own inventory of parent 30,000. Parent company will have own inventory of 30,000. What I got from these people are worth 13,000. So the parent company inventory will be 43,000. Again, not in the parent company books, but when you are consolidating, we will remove that 750 from our inventory because that amount is overstated by 750. Even though it is overstated by 3,000, I'm not worried about the 75%. I'm worried about the 25%. So I will put my inventory at 42,250. So you have to reduce your consolidated retained earnings and reduce your inventory. Earlier we saw reduce your consolidated retained earnings and reduce your investment in associate when the parent sells to the associate. But when the associate sells to the parent, you don't reduce the investment in associate, you reduce the consolidated retained earnings and you reduce the inventory. So when we are looking at some numbers, we will see this thing working very well. In the consolidated statement of comprehensive income, reduce your share of profit of associate. So we will show a profit from associate of 5,000, but remove 750 and show only 4,250 in the consolidated statement, not in the single entity, not in the A company books, not in the P company books, but when you are preparing what we call the consolidated financial statements, that adjustment will be done at that point. So the next subject is what we are going to look at is investment. You want to do it 1 hour today, no?
Yeah, 1 hour, so it probably doesn't make any sense starting this one. I mean, we can finish up now if you want. That's
Yeah,
okay.
that's right. I'm not going to start on the investment in subsidiaries. That's the next area. So we will look at that one when we meet next. That is the investment in subsidiary. And then we will look at both together.
Okay.
So we have our session on Sunday, is it?
Yes.
Sunday, what time we meet? 9:30.
Yeah. Do you want to?
Yeah, no.
Is that time okay for you?
Yeah, anytime. Sunday, no problem for me. What is the? We normally meet at
9:30.
9:30. No, 9:30 is all right by me. Yeah.
Yeah. Okay.
So we will meet on Sunday 9:30.
Okay.
Thank you. Take care.
All right. Thanks, Kumar. Have a good week.
Thank you.
Bye.
Same to you. Bye. Bye.
Okay. Bye.
Bye.